This is not financial or investment advice. The information provided is for educational and entertainment purposes only. Please always do your own research and consult with a licensed financial advisor before making any investment decisions. Thank you, guys.
Hello, everybody. Welcome back. And today we're going to be talking about mortgages. Yes, the topic that everybody is dying to learn about. Most people think a mortgage is just a loan between you and the bank. But in reality, that loan gets bundled, sold, and traded on Wall Street. So let's break it down. I'm going to do a quick overview on what the video is going to cover. So we're going to go first into what is a mortgage, and then second, how banks make money on mortgages, how your loan becomes an investment product. The basics of a mortgage. A mortgage is a loan from a bank that allows you to buy a home. In exchange, you pay back that loan plus interest over a set period. Usually 15 or 30 years. 30 years is the much more common one. The home itself serves as collateral. If you don't pay, if you miss your payments, the bank can take it back. There are many different types of mortgages. So there's fixed rate mortgages, which are the ones we're going to be covering in this video. There's adjustable rate mortgages, and then there's loads of types of mortgages in between that private lenders, public lenders, special programs do. This is including, but not limited to, like FHA loans, VA loans. VA is Veterans Association, which obviously in order to qualify for that type of loan, you would have to be a veteran. For the sake of this video, we're only going to be really covering the 30-year fixed rate mortgage. The truth about interest rates, addressing some common misconceptions. A 6% interest rate doesn't mean you pay 6% of your home's purchase price. Loans are structured so that in the early years, most of your payments go towards interest, not the principal. Why? Why is that? Interest is actually calculated on the remaining balance. And in the beginning, your loan is high. Over time, as the balance decreases, more of your payment goes towards the principal. But obviously, banks want to make sure that their investment gets paid first. So you can see on this graph here, the amortization for a $400,000 mortgage on a 30-year term and a 4% interest rate. You can see that the majority of your payment at the beginning is going to be being paid in interest. And then as it goes on, the interest goes down and the principal payment goes up. And this eclipses roughly 10 to 15 years in, right? And you can actually see what those amortization payments look like on this chart right here. In this example, the amortization schedule is for a 30-year home loan, same amount, with a 4.125% interest rate and the loan amount of $185,000. So here you can see on your first payment, only about $260 is going to your principal and $635 is going to be going to your interest. So that means that at the beginning, around 70% of the payment that you're making is actually going towards paying for the bank's profits.
So if we take a look at this graph again, most of your payments in the beginning are being paid towards interest, like I said earlier. But there's something really interesting about this. If you look at this graph that was put together by Redfin, the average American right now is only staying in their home for about 13 years. Why is that? It's because they either refinance or just sell their house. This means that most people don't even get to a point in their amortization schedule or in their payment schedule to even be paying mostly equity, to be paying mostly into actually the amount that they owe on the house. So you can kind of see how this cycle continues. People only spend about 10 years, 13 years in their home. They pay mostly for the bank's profits and then they sell, move on, and then they jump right back into the same thing in a different home or in a different area.
So if you compare this to credit cards or even personal loans, credit cards can charge you up to 20% or more in interest because they're unsecured. They're only backed by your credit worthiness, right? Your FICO score or whatever that is. Now that we know roughly how a mortgage works, how do banks make money off mortgages? So most banks don't actually hold on to mortgages forever. First, we have to understand where banks get the money to even give you a mortgage. So if you are buying $1 million house and you put 20% down, the bank is basically fronting you $800,000 to pay for this house. Well, where are they getting the money from? They're getting it from people like you and me. It's really crazy to think about. So when you have a checking account with a bank, you basically allow them to borrow your money and lend it to other people. So the same dollar that's in your bank account that's being represented by a 1 is also in a completely different place backing somebody else's mortgage. Really crazy to think about. This is what's called the fractional banking system. I'm not going to explain this. I'll link a video down below that does a very good job explaining how the money works for stuff like that. But the fractional banking system allows for these banks to lend money to people so that they can buy homes. Okay, well, now there's kind of a problem because that money is tied up for 30 years. So what do banks do? How do they get their money back? This is where they sell them to investors so that they can free up that cash and issue more loans. This is what's called a mortgage-backed security. It's pretty cool. So what is a mortgage-backed security? Think of an MBS like a bundle of thousands of home loans sold as an investment product, like those cheese and salami charcuterie boards. You get something of everything, right? And they bundle these together and sell them as an investment product to investors. Investors like pension funds, hedge funds, foreign governments. These are the people buying these bundles and earning money when homeowners make their mortgage payments. So it's pretty crazy to think that your mortgage could technically be owned by some foreign government, right? And they're the ones that make the money from you paying your bills. Essentially, your mortgage is being traded on Wall Street. We're going to break this down a little further. Not all mortgage-backed security investments are created equal. This is where tranches come in. Mortgage-backed securities are divided into risk levels called tranches. So the senior tranches are paid first, which means they're lower risk, but also lower return. The mezzanine tranches, or in the middle, are moderate risk, moderate reward. And then there's the junior tranches, which are paid last. They're high in risk, but obviously you get a higher return because of that. Why does this matter? Different investors want different risk levels, and that's all there is to it. Then you can go a step further to something called CMOs, which are collateralized mortgage obligations. This operates similarly to a mortgage-backed security, but a CMO is a more structured, advanced version of a mortgage-backed security that organizes payments in an even more complex way. So investors in different tranches instead get paid at different times. So an example of this, a retiree might invest in a safe tranche that gets paid first. A hedge fund might invest in a high-risk tranche that could offer huge returns, but also be the first to lose money. So just to put this into perspective, this essentially makes banks a sales pipeline, where their role is not to hold on to your mortgage, but to originate loans, package them, and sell them to investors. They're not just lending money. They're creating a product, the mortgage, to be sold in the secondary market. This system kind of works like an assembly line. Banks qualify borrowers by assessing credit score, income to debt ratio, and then they issue the loan knowing they won't hold on to it long. The mortgage is bundled into mortgage-backed securities and sold to investors looking for returns. And then the cycle repeats. The cash that they get from the people buying those mortgage-backed securities, they use to give out more loans. Why does this model exist though? Banks don't want to keep 30-year loans on their balance sheet. It ties up capital. Selling mortgages lets them keep lending and making money from fees. Investors like mortgage-backed securities because they provide steady income from homeowner payments. And like I mentioned earlier with these tranches, as an investor, you can select the type of risk profile that is most suited to what you want to do. Now, how can this be a problem? I'm sure a lot of these words that I've been using has maybe been setting off some red flags in your head or reminding you about the 2008 financial crisis. So since banks don't hold on to mortgages, they have less of an incentive to be cautious. They just need to qualify borrowers and pass the loan off. So this led to subprime lending in the 2008 financial crisis. Banks gave loans to risky borrowers because they knew they wouldn't be stuck with the risk. This system is highly dependent on investor demand. If investors stop buying mortgage-backed securities, banks tighten lending, making it harder to get a mortgage. So why should you care about this? Maybe you shouldn't. But I find it really interesting to know that because of all these financial instruments and because the way that banks package mortgages and sell them to investors and other financial institutions is the reason that people like you and me can go out and buy a house and start a family. You know, it's because of the incredibly complex financial system today that we are allowed to do seemingly mundane things. And that's pretty cool. Let me know what you guys think in the comments down below. If you think this is bad, if you think this is good, or if you think it's more nuanced than that, like and subscribe. And thanks for watching.